For the next hour, you'll be leaving the Show Me state and entering the Show Me the Money state. So stop what you're doing, grab a pen, and get ready to learn. Randy and Jake Floyd of Floyd Financial Group will be your guides for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Randy Floyd, Jake Floyd, and Jeff Shade.
Good morning. Thank you so much. Welcome to Show Me the Money, the radio show that gives you the straight talk and honest answers you need to reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about current events. Then we'll talk about where to put money now that the Fed has cut its rates. Can your money outlive you? And finally, a phased-in retirement. My name's Jeff Shade. As always, I'm just here to ask the questions, but the words of wisdom and solid advice, they come from Randy and Jake Floyd of Floyd Financial Group. Randy, good morning. How are you this morning?
Very well, Jeff. How about you?
I'm doing great, thank you. And Jake, good to see you. Good to hear you. How's this Saturday morning treating you?
You know, I'm just grateful for all the rain we got last week. It was much needed. But other than that, I'm doing great. Thanks for asking.
I am glad to hear that, Jake. You know, the leaves are starting to fall, at least in my lawn. And before you know it, the holidays are going to be here. But there's a lot to be grateful for. And among the things that we're grateful for today is our ability to communicate with our audience and to have such a great audience out there listening to us. So I hope everybody else is having a great day and a great morning. We appreciate you joining us here on Show Me the Money. Let's talk about what's happening right now in current events. The Fed has cut rates. It's only 25 basis points, though. What does that really mean to folks?
Well, it just basically means there's a sea change in what's going on here, right? So for the longest time, we had really low interest rates. And then, of course, after COVID and inflation hit, Jerome Powell raised interest rates at the Federal Reserve Bank level from 0.25 to 5.25 to 5.5, and then since that time, rates now are 4 to 4.25%, and they were again at the high point almost 5.5. So that's really quite an improvement, and people should be thankful. We're going to start to see rates trickle down, and it's the first time. I think it's been first time for sure this year. It may have been as long as 14 months since we've had one.
Yeah, it's been at least 4 or 5 sessions, and later on in the program, we'll be talking about where to put your money now that the Fed has cut this rate. Markets are now anticipating maybe 2 more cuts before year-end, possibly more in 2026. Do you think that that's actually going to happen, or do you think, he said, listen, you're on me so much about the rate cuts, I did it, now I'm just going to relax for a while?
No, I think if we look at the fact that we got weak job growth, we've got economies. The people that are studying that are telling us we're growing at maybe a 1.6% rate, where it was a little higher than that previous months looking back over our shoulder. So I think that Jerome had to respond to this data, whether he wanted to admit it or not. And of course, I think too that the market had already priced in this cut. And had he not done it, it would have been very negative for the market and potentially even very negative for growth prospects looking forward. So I think the easing on the interest rates is going to make it much easier for small and mid-sized companies to go out and grow and expand their business, which is what we need if we want to grow the economy.
And as you said, we've had some weak job growth here. Recent job reports, 22,000 jobs added in August, suggesting a weakening labor market dynamic. Some indicators are pointing to a slower GDP growth and rising concern that economic momentum is fading just a little bit. Do you think it'll continue to fade throughout the year, and why?
Well, I think Donald Trump had told us that he was too late and he should have been lowering these rates sooner. Of course, right. Everybody's concerned about the return of inflation. I think a couple of things, though, that I just alluded to. If we get smaller companies and mid-sized companies growing and expanding, they can put pressure market-wise on the larger companies, which can, in fact, actually help to drive prices lower, not higher. So, if we look back over our shoulder, we had 0 interest rates at the Fed level for a very long time and couldn't get to 2% inflation. So it's not the idea that money's too cheap that makes inflation possible. There's too much money in the system, which is kind of what happened during COVID with the $6.5 trillion of new money being printed and injected into the system that's driving, and it has driven inflation. I don't think it's so much the interest rate.
We were looking for a goal of inflation being 2%. It has never really reached 2%, Randy. As a matter of fact, it's going the other way. Last I saw was right around 2.9%. How is that going to affect things moving forward? And do you think we're going to see 3% inflation?
Yeah, so the 2.9 we know was a derivative from the producer price index earlier in the year. Now, the last time we looked at the CPE, you're right, it was about 2.9, but the producer price index, which feeds into that, was actually negative 1/10. So that will filter through and come out in the CPI coming up soon. So I think we're fine. I think it's going to tick down some. And I think that, yes, we may have a couple more rate cuts before year end.
So do you think we should pay more attention to the PPI or the CPI? The PPI being Producer's Price Index and the CPI Consumer's Price Index.
Yeah, I mean, they're both, of course, tied together. However, I will say that, again, when you look at consumerism and all this extra money and the fact that people are willing to pay the price has a lot to do with inflation. So if we can introduce more competition, that should drive prices down. If people are paying $10 for a hamburger, they might pay $11. And so
not me, thank you.
They're going to test the water, right? But if all of a sudden people stop buying $10 hamburgers, they might lower their price to $9.50.
Even beyond that, and while I agree with that sentiment, I think what may be more powerful is the power of competition. As these companies become more profitable, where they're used to making 3 and 4% profit margins on hamburgers, if all of a sudden they are able to lay off part of the workforce and make more profit, let's say their profit goes to 10%, then we have, some of the people listening to the show may remember gas wars. Back in the day, right, where the gas station across the street would be at competition with the one on the other side of the street. I think you'll have burger wars and everything wars where you're going to see, hey, we have all this newfound profit. Let's let competition take place and bring prices down that way. Whereas, well, maybe we'll do $9.95 for the hamburger. Well, what about $9.90? $9.90,
right.
And so you go down. I think that will also put downward pressure on prices for kind of the same reason, but a little bit different.
Hamburger wars. I can't wait for that one. We got a McDonald's in my neighborhood right across the street. Literally, they're building a Hardee's. So I cannot wait to see that war happening there. And one's going to be having a sign that says, we're better than that one. And that one's pointing over there. The fingers are crossed. And, everybody's looking, where do we go to get our hamburger?
Definitely sounds tastier than
doesn't
gas
it, though?
wars.
Yeah, exactly. Hardee's on this side. And we got McDonald's over here. Who's going to win the big battle of the burgers here? Listening to Randy and Jake Floyd Financial Group, our program, of course, called Show Me the Money. We appreciate you joining us each and every Saturday here on KSGF. Our phone number, 417-889-7233. If you'd like to come and sit down and talk to Randy or Jake, no cost, no obligation for your Floyd Financial Group retirement review. We'd love to talk to you, 417-889-7233. You can make that phone call right now. Let's talk about stock markets. They're still hitting record highs despite the risks. And it seems that really there isn't any justification as far as valuations go. What's your opinion on what's happening in the market that way?
Well, Jeff, we talked about that we think AI is the current industrial revolution like we had back around the turn of the century, back in 1920. Right. And 29 and 30 through there. So I think that's driving a lot of it. And who knows where the height of that goes. And yes, we have some companies that are trading at pretty high multiples, but we also have some of those AI companies, the Metas and Oracles and a lot of those companies that are not trading that far out of line for what we would call extreme growth companies, which I think anything to do with AI right now could be considered extreme growth. So even though we're seeing all-time highs, I think with what's coming in AI and the profitability that may come from that, as well as the fact that, again, we are still digesting all the money we printed and put into the system, that's going to flow to the market and to real estate prices. Markets, I think, will continue to hit record highs. I would not be a bit surprised to see 7,000 in the S&P 500 by year end.
So let's shift now to asset allocation towards equities. Investors and households and pension-defined contribution plans, they're holding greater portions of their portfolios in equities versus bonds. Why do you think that that's happening?
Well, again, we've had this sea change where generally, Jeff, if interest rates are going up, it's not good for the market. If interest rates are coming down, it typically is good for the market, not so good for bonds. So when Jerome Powell raised interest rates and we could get short-term treasuries at 5 and north of 5 for a while, it was a good place to hold money because it was liquid. We could get to it. It paid 5.5% there for a while, and people were pretty happy with that. Now, though, that rates are coming down, people holding those bonds as rates trickle down, they will get some appreciation in their bonds as well as the interest they collect. But at some point, we're going to transfer a lot of that money over to the equity side. And so that's what's going to fuel a lot of growth looking forward.
Randy, I also understand that sentiment and confidence is under strain right now. A survey from U.S. Bank shows that a lot of Americans feel that the economy has outsized influence over their retirement timeline and their ability to buy a home. A lot of retired folks are worried that they might have to re-enter the workforce, and that is due to stress and worried that they're just not going to make it here. What do you make of that in terms of consumer sentiment? How important is that to recognize that that's what's going on?
I don't know. I mean, from my perspective, just seeing clients and talking to people every day, I don't know that the anxiety really is that much more than I have seen in past. Now, not to say there's not anxiety out there with the wars and rumors of wars and who's blowing up who and the Charlie Kirk thing and all the stuff that's going on around the market. But I don't think, as far as investors go, I see people being any more nervous about investments and bonds and stock market. But what really kind of has got them nervous is the fact that all this other stuff that's around it, right, that we can't control. The geopolitical forces, nobody can ever predict or control. But as far as just the markets and things in general, I think the markets are running pretty efficiently and really are looking at things in the right light, if you ask me.
So it sounds like that the people who come in to see you here at Floyd Financial Group are really pretty confident about what's going on, and especially, I would imagine, once they talk to you as well, and you lay things out for them, it becomes more clear that they can make it to and through retirement. What do you think that people should be looking out for now as the fall turns to winter here and 25 turns to 26?
Well, that's a great question. The United Nations has been meeting, and it's going to be interesting to see what shakes out of all of that. If anything, the last time they got together, tried to adopt a resolution, they had to leave without one. So we'll see what happens. We've got the Palestinian thing on the line here, along with NATO, and Turkey wants to be admitted into the European Union. They never have been. We'll see what happens there. They're kind of a crucial part in this whole area over around Ukraine and Russia and all that. So there's a whole lot going on right now. Keep your head down, hang on, and watch for what's going on there. But I would say, as far as investments go, let's see what Jerome does as far as taking interest rates down. Let's see what happens with corporate profits, which Jake and I are always watching, and you know, who's buying who's going public, who's not, who's getting stupidly speculative, and who's not. I mean, there's just a whole lot to watch every day. And of course, that's why we're here. We're here to help people navigate this thing called retirement and keep their investments as safe as we can and make as much as we can along the way.
Right. And you mentioned the term stupidly speculative. I like that term. It's an official financial term, I guess. And when you said that, I thought of gold and silver. You know, that's still going great guns. People just think if I buy gold and silver, if I hold it in my hand here, that it's going to hedge against inflation. Do you get many people asking about that who come into the office?
Every day, people ask us about that. And it's not that we're against gold or silver or any precious metal. And I would say also in that same category for retirees is real estate.
Right.
I mean, those are all great investments if you have time. Jeff, I don't know that buying into gold at $3,800 an ounce is a great move. I don't know how many more people actually are going to be willing to put money into gold. It doesn't produce a dividend. It doesn't make anything.
I think that's the key. And that's why Warren Buffett, again, I don't agree with a lot of his politics and things, but his investing prowess is very difficult to argue with. And that was always his thing about gold. Why don't you own gold, Warren? Why don't you own gold, Warren? Because it doesn't produce anything. Right. And to Randy's point, you know, even real estate produces revenue if there's a renter in there, that kind of thing. Crypto and gold are unique in the fact that they just sit there. Now, people are going to be like, well, that's not true of crypto. You know, if you're a crypto bug, you know, you can stake your crypto and it produces income. And that's true. But that's actually still speculation on the back end because it doesn't actually produce anything. People are just paying you to stake it because they like the lack of liquidity that causes and potential price movement thereof. Those two assets are uniquely positioned because they don't really kick anything off. And from a long-term perspective, that's generally not a good thing. In the short term, speculation can drive anything anywhere, as we've seen with cryptocurrency and other things, and even gold. But over 20 years, 30 years, 40 years, the long haul, something that produces income, produces a product, produces something, will generally outperform an asset that does not.
Right, and you're talking about commodities, and I've often said that I think commodities are speculation. They are not investments, and you have to keep that in mind. And Randy, you mentioned turkey just a moment ago. Turkeys are beginning to show up in the supermarket. You know what that means? That means Thanksgiving is on the way. We're smack dab in the middle of fall right here. Listening to Show Me the Money with Randy and Jake Floyd Financial Group. My name's Jeff Shade. Glad you could join us here this Saturday morning. Once again, before we go to our first break, I want to remind you that our phone lines are open for you to make that call at 417-889-7233. If you'd like to get your Floyd Financial Group retirement review, no cost, no obligation, leave your name, telephone number. Ashley will be in touch with you early in the week next week and set you up with that appointment. No cost, no obligation. Get yourself all set up for the holidays so you can have a worry-free holiday, if you will, knowing that your finances are on the right track. It's 417-889-7233. And, of course, we're online at FloydFinancialGroup.com. Time for a break, Randy and Jake. When we come back here on Show Me the Money, we're going to be talking about where to put your money now with the Fed's rate cut when our program continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready for another helping of some more real money talk? Thought so. Now, here's another serving of Show Me the Money with your hosts, Randy and Jake Floyd with Jeff Shade.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money. And in this segment, we're going to be talking about where we put money to work now that the Fed has cut rates.
And Randy, let's start at the top. What's the Fed signaling with this quarter-point rate cut, and why now?
Well, he's signaling the fact that he may think that inflation is coming down. However, it might just be that he's been beaten to a bloody pulp and decided to give in.
I think so. All the things Trump has called him, it's like, I've had enough here. Let me just do it. This will be the lesser of the two evils. The pain will be less if I just cut the rates.
Yeah, so every time Jerome puts out the rate changes, 30 minutes later, he gives a press conference for about 45 minutes. Even prior to that, during the rate announcement, they put out what's called the dot plot, where it shows each individual Fed member's view on where Fed policy should be next meeting, 2 meetings out, 3 meetings out, 4 meetings out, and so on. And I think that we've seen a major shift in the Fed where we've gone from maybe we'll get one cut over the next 6 months to the average Fed member thinks we're going to have 3 cuts before January. So that's a big shift. There was even one of the new guys that Trump got in there that said we need 5 rate cuts before the end of the year, which would, obviously there's not 5 meetings. So he's saying we need to go 50 and 75 basically to get to where he thinks we should be. So I think seeing that big shift means that interest rate policy is now going to start shifting downward. The bonds, the 30-year treasuries, the 30-year mortgages, all those have bounced a little bit in yield, meaning the anticipation ahead of the meeting was that they were going to cut, and they did. And so now things are actually going the other way. They're going back up because they had a pretty big slide going into the meeting. But I think we're going to see it ebb and flow, and we're going to generally see rates lower and lower and lower. And as that happens, that's generally very good for asset prices, both real estate, stock market, and so on. And so I don't want to jump too many points ahead here, but I just wanted to say that the shift in the Fed's overall countenance, if you will, has been very good as from a market standpoint and probably from our debt standpoint also, where we can really start to refinance some of this debt at a much lower rate. So I think all that's kind of starting to play out in a way that I've been expecting it to for longer, but it is finally coming around here, so that's good.
For everyday people listening, guys, what does a 25 basis point cut actually mean for mortgages and credit cards and car loans and the like?
For mortgages, it probably equates to $100 a month. Average mortgage, they say, is around $400,000 out there right now for a house, so you figured a quarter point. It's about $100 a month, and interest is the change. For credit cards, I don't think it means anything. I don't think those guys, unless they're forced to with a mandate or a law, they're ever going to cut rates.
Right.
And then car loans, yeah, there probably will be a little more competition there. But the car business itself in general has a bigger problem, and that is they are pricing the average buyer out of the market, and they're going to have to bring some of those prices down for sure.
But I do think this plays into what you were talking about earlier. If people are willing to pay and can pay, they will continue to pay. And the prices are not going to come down as long as people can pay. Now, I realize there are people that can't afford to pay, but the average person out there clearly can, otherwise prices would not be as high as they are. And so the dynamic between used cars and new cars is going to get very interesting here, because it really makes a lot more sense to buy a new car if you can than even one that's 3 or 4 years old if you get a much better rate on it. Now, as rates get compressed, we're going to see used car rates come back down, which is going to put some pressure on the new car market, because it's been such a strong used car market for so long that a lot of people are buying new cars where they wouldn't have otherwise. And so I don't love the car market here from a stock perspective looking forward. I think there's a lot better places to put money. The only exception to that would be Tesla, but mainly because it's not really a car company anymore. I don't think Tesla is going to be immune to those problems either, but Tesla has, autonomous and robotics and all that kind of thing. But I think that's going to be a big player in the market overall. The car market is a very large market. It's not like housing, but it is probably, and again, this is a totally off the cuff guess, but I would say it's probably 3 or 4% of GDP revolves around the car market. So if that starts to dry up, that will put some downward pressure. But I think there's a lot of other things exploding that are going to be much higher that will more than offset that.
We've talked a little bit about how the markets are reacting, stock market, but what about bonds and the dollar? What stood out to you in the immediate aftermath of this rate cut?
We've been seeing the 10-year Treasury bill tick down from, I think at its high, it was nearly 4.5 here, looking back over the last 6 months or so, but it's been hanging around 4.05, 4.15. And so I think we're seeing a little downward pressure on that yield there and what people are willing to buy, really. The yield curve, which generally says the shorter term I have on a bond, the lower I get paid, and then the longer I have a bond, the more I get paid, is finally starting to get back closer to its normal trajectory, where it was that the longer I went, the less I got paid, and the shorter I went, the more I got paid, when Jerome had raised interest rates to 5.25 to 5.5 at the Fed funds level. So I think we're going to see that's going to get back to a more normal yield curve. As interest rates come down, anybody that owns a bond may get a little price appreciation in their bond, and at some point we'll be able to sell that and realize that gain as well as the interest they've collected. But I do think that's going to play into stocks and push the stock market up as we see these rate cuts continue.
Well, I know that the rate cut is only 25 basis points, but given this new rate environment, where do you think investors should be thinking about putting money to work right now?
Yeah, so I think that if they aren't talking to their advisor about that, or if their advisor is not on the cutting edge of what's going on there, if they haven't heard anything, or when they talk to their advisor, they're not talking about a shift in where money is going to and coming from, they need to be finding somebody that's going to be talking about that to them, because there is definitely, especially if we get 3 more rate cuts before year end, you're going to really need to rethink where some of your money is, most likely. And that, again, that's going to skew it mainly toward something that's market driven rather than bond rate driven.
How do you think retirees or income-focused investors should be thinking about bonds and fixed income now that yields might be coming down a little bit?
I think that the shift in sentiment at the Fed is kind of like starting the ticking timer on bonds, where bonds look pretty good in the short term here. And short term, I mean 6 to 24 months maybe. But after that, we're going to be back to where we were in 2010 when you're picking up pennies in front of the freight train. But in the short term, this is probably as good as bonds have looked in 20 years, in my opinion. And so I don't hate bonds here, but it is going to be necessary to ride this wave and then exit at some point so that you don't get crushed going back the other way. So to Randy's point, you want somebody who's going to be watching this, not necessarily that he needs to be cramming it down your throat either, but you want to make sure that at least he or she is paying attention to what's going on so that you don't get rolled over by the steamroller that is the bond market. A lot of people don't realize that the bond market is still larger than the stock market.
Oh, yeah.
By volume and by total investment. So it is going to thrash around, not like an 800-pound gorilla, but like an 80,000-pound gorilla, and it will crush anything in its way. So if we don't have some kind of strategy to navigate that, I think it would be a good time to come up with one.
Are money market funds, CDs, still attractive, or is that trade fading, do you think?
So it's kind of the same as the bonds, except that you don't get the upside potential of a rate decrease. So you basically have the days are numbered on easy cash yields, in my opinion. Again, this is my opinion. It doesn't make me right, but it is an educated guess. I think that you're going to see, we had yields on money markets as high as 5.25 not too long ago, and then we were at 4.25. Now we're at 4. And as they cut rates, you're going to see short-term money market rates continue to tick down. You'll probably see banks dry up first because they don't want to get stuck holding the bag. I would suspect that at most banks, if you go back and you start asking for 1-year CDs, their rate is already going to be in the 3s, not in the 4s anymore, even though they could afford to pay 4. They just want to make sure they don't get hit by this later as the Fed kind of winds down the higher interest rate policy. So again, similar to bonds, but we don't necessarily have to worry about getting crushed by it later. We just have to worry about how much interest we're getting. And we've gone from getting quite a lot of interest on safe money to that's going to really start to dry up, in my opinion, over the next 4 to 6 months. And then into the next couple of years, it may dry totally up, depending on what happens. But that remains to be seen.
For those people who are risk averse, and I know that there are a lot of conservative people who listen to this radio program, they love CDs. Is it a mistake to lock in a long-term CD at this point?
I think that CDs are fine. There's nothing wrong with them as long as you can get yield and as long as that's your safe money, right? We don't want to have our risk money in CDs because we're going to get, the market's going to crush CDs over the long haul. But in the short term, it may not. If you try to go more than about 7 months, I would suspect that rates will be quite a lot less than they were the last time you checked. And if you have a CD that's coming due when you go to get that CD re-upped, it'll almost certainly be less than it was the last time you invested it.
Right. And the other thing, Jeff and Jake, is this. I remember looking back over my shoulder years ago, 2-year, 3-year, and 5-year CDs were common. If you try to get a 5-year CD today, a lot of them don't offer it.
Right.
And if you do, it'll be less than the 1-year rate. And that's, again, because they don't want to be stuck holding the bag, not being able to be competitive when they're loaning money to the general public.
Randy and Jake, if you had to sum up the Fed's cut in just one sentence, what's the takeaway from Main Street?
That inflation is headed down.
I would say let's get invested and stay invested.
All right. Very, very good. We're talking with Randy and Jake Floyd Financial Group. We've been talking about the Fed's rate cut, of course, 25 basis points right now. We could have some more by the time 2026 turns the calendar here, but we'll just have to wait and see. And of course, in 2026, we're hoping that more will happen as well, too. And if you have listened to the program today and our conversation has piqued your interest, you'd like to come and sit down and talk with Randy or Jake at Floyd Financial Group, talk about your journey towards a confident retirement, we'd love to do that for you. We've got our Floyd Financial Group retirement review that we're offering at no cost and no obligation. Of course, no judgment. Will meet you where you are. To get yours, call 417-889-7233. It's 417-889-7233. Entirely complimentary. Again, it's not going to cost you a dime. Make that call right now. Ashley will call you back during the week and set up that appointment for you. Just leave your name and telephone number. Once again, 417-889-7233. We're online, of course, at FloydFinancialGroup.com. Let's take a break, Randy and Jake. When we come back here on Show Me the Money, can your money outlive you? All that and more when our program continues here on 104.1 FM KSGF, where Springfield comes to talk.
We're back with your financial catch of the day, and it's a big one. Here's more Show Me the Money Radio with your hosts, Randy Floyd, Jake Floyd, and Jeff Shade.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money, and in this segment, we're going to be talking about can your money outlive you?
And Randy, in practical terms, what does that actually mean? Can your money outlive you?
I promise you that money will outlive you. But
I'm sure there's some currency lying around that's older than I am, but that's not really what we're talking about. The dollar bills are maybe hanging around from the 40s and the 50s, but we're talking about your money outliving you, having enough money till you no longer need money or go to a place where money doesn't matter.
Yeah, Jeff, for most retirees, what it's about is making sure that you don't outlive your money and run out before you're ready to run out. Now, when would you be ready to run out, I guess, would be my question. So this is one of the things that we talk about every day in here, and people have a hard time sometimes figuring out, well, I've got this money now, but how's that going to play out in the future? And what about inflation? And what if I get sick? And what if my spouse dies before me and I lose some of my retirement income or maybe their Social Security? All these things are things that we have to think about when we build retirement plans. And it's something that Jake and I spend and have spent many hours contemplating, just like everybody else in the financial industry does. But we've really kind of zeroed in on some systematic stuff that works. And then, of course, we're always watching what's going on globally, what's going on in the U.S., what's going on geopolitically, what's going on with interest rates, what's going on with different market sectors. Market sectors don't always grow. They grow for a while. They get what we would call overbought. And then we have what's called a sector rotation. And people tend to get out of there because they're afraid prices will go down. They want to protect their profits, and they run someplace where they can buy cheap or maybe look for a value stock that's maybe down for a little while. So all those things come into, am I going to outlive my money? And so what we do is we design plans for retirees that are conservative enough to make sure that doesn't happen, but aggressive enough to make sure you make some money. How about that?
That sounds good. In retirement these days, it could last 20 years, 30. Even some people have retired for 40 years if they're lucky enough to do it very, very early. So certainly your nest egg needs to last. Now, when I think of my grandparents a couple generations ago, they didn't have any money. Almost literally, they had no money, but they lived off the land. They grew vegetables and things like that, and they raised chickens and cows and that sort of thing. But today, it may be a lot different. So why is this question more important today than it might have been a generation or two ago? Is it really just longevity risk, or the fact that really in today's society, you can't do that because even if you do own land, you probably have to pay property taxes. Somebody's going to be having their hand out for you.
Yeah, that's for sure. I think back about my grandma on my mom's side, and then I think about the Floyd side on my dad's side. The Floyds were maybe a little bit more entrepreneurial than the Maggards. The Maggards did fine. They had a farm. They had however many cattle, however many hogs, and however many chickens. But what you're kind of alluding to is it used to be people didn't need much to go out and live on. Today, we have to go buy everything because most people, if they raise tomatoes in the backyard, they raise 15. And I remember my grandma and grandpa Floyd, they always had hired hands to help them work a much larger farm. They also had a 2-acre garden that yours truly got to go out and hoe every year with grandma, right? And then we made sauerkraut and we canned green beans, all that stuff. But today, people have to be able to have money to buy those things because they're just not, well, most people don't have acreage to grow things on, and most people don't have enough acreage to have a cow or a hog or whatever out there. So just a lot different environment than we live in today, because it used to be, it was all agrarian and people could get by, and people didn't stop working until they couldn't work anymore. And then they moved in with their kids, and their kids took care of them at home until they passed away. But in today's world, it just doesn't work that way, because the kids, they aren't on a farm. They're off to work somewhere. They don't have the time or the wherewithal to help mom and dad. So a much different scenario for retirement today. We've got to figure out, hey, what happens if I fall ill, and how do we pay for that?
Right, and we have Medicare today, and that brings to mind health care. And in the old days, before I guess there was Medicare, I don't know how old Medicare really is, but I mean, Granny used to do the doctoring around the house there, and she would whip up owl soup or maybe a possum on a platter or something like that, with little herbs and stuff like that. I don't know what she did, but anyway, she would do the doctoring around the house. Healthcare costs today are a lot more expensive, so living without money is something that is just unrealistic today. People are living longer, and you can't just rely on Social Security anymore these days, Randy, or do you have people who do that?
We have a few people that are still able to live on Social Security pretty much exclusively. Now, granted, they're not living, as we would have said back where I grew up in Bradleyville, high on the hog.
Right.
Whatever that means.
Well, typically the cuts of meat higher on the hog are the better.
Not
are
bacon.
The better. They're living on tenderloin.
I see.
Okay.
I got you.
Or pig's feet.
I think I prefer bacon, though.
Pig's feet is down at the bottom. I imagine that's probably the lowest one.
Yeah, no chitlins for me.
Me neither.
Yeah, today Medicare and Medicaid play big roles a lot of times in helping to close that gap where people just can't afford maybe to pay for long-term care.
So we don't want to run out of money. What are the main factors that determine whether someone's money is going to last through retirement or it runs out too soon? How can we predict this if we can predict it?
Can we predict it? Yes, we can. We've been doing this long enough that some people will come in and their expectations of what they can withdraw off of retirement assets are too high. We have some people that come in and theirs are, well, I don't need that much, and they're going to continue to scrimp and save all through their retirement years and not really enjoy it much. And then there's the people in the middle of the road. Now, I would tell you that in today's world, we have a lot of people in the middle of the road, but we do have those folks that say, you know what? I can never, ever stand to lose a cent. So I want all my money in money markets and CDs. Or we have people who come in and say, hey, I know that the market always goes up. I'm going to go ahead and spend 15% of my assets each year, and that'll work out, right, Randy? And I'm like, well, no, probably not. I mean, it'll work out. Yeah, but it ain't going to work out the way you want.
Mm-hmm.
But so we have to help kind of guide people through that process. And that's what we're here for, because we've helped literally at this point, thousands of people retire. And so building those portfolios, helping people to understand they may live 30, 35 years in retirement. They may have a large health care bill, long-term care. We have to factor all those things in when we build these retirement plans, because we just don't know how long people are going to live. And the thing we know is nobody wants to be 90 and out of money.
Talking with Randy and Jake of Floyd Financial Group, we're talking about running out of money before you run out of life. Again, our phone number, 417-889-7233. If you'd like to come and sit down, talk to Randy and Jake about not running out of money in retirement, maybe we can take a look at where you are right now to make sure that that does not happen. We certainly may have a plan for you. No cost, no obligation for this consultation. Entirely complimentary, and there is no judgment. We'll meet you where you are. 417-889-7233, and of course online at floydfinancialgroup.com. Are there any rules of thumb for how much people should aim to have saved before they retire, or does it just depend, and depend on what?
As much as possible.
Well, I think it's a pretty good answer. Have as much saved as possible. But what if it hasn't been possible to save very much money? I mean, how can we really get through retirement if we don't have enough money? What are the predictors that we're going to be in trouble with a capital T?
This is something we talk about a lot, the 4% rule, the 5% rule. Maybe an easier way for a lot of people to understand is you want to have saved 20 times what you need to pull out each year. So that would be 5%, right, of what you're taking out. But let's say, hey, I need $1,000 a month off my investments to supplement my retirement income from Social Security and my pension. Well, $1,000 a month is $12,000 a year, times 20 is $240,000. So I don't know if that's easier or harder. Maybe I'm just thinking it's easier, but we like the 5% rule better than the 4% rule, as long as we have a few safety nets in place, which we can talk about when you come in for your consultation. That's a good way to look at it. So if you need $3,000 a month, then 3,000 times 12 is 36,000, times 20 is 720,000. Right, so that's kind of a relatively easier, I think, way to think about it.
I like that a lot, Jake. I mean, that really does kind of simplify it. Now, here's the thing we don't know, and that is we don't know how much you're actually going to need until you get in here. So if you're one of those people that's fortunate enough to still have a pension today, as well as your Social Security, you may not need to have that big a nest egg, because you may only need the 1,000, as Jake says, or you may only need 2,000 or 3,000. So I would caution people not to assume that, wow, I just don't have enough yet. I wouldn't do that. And the thing I would say is, come see us. Let's sit down. Let's talk. Let's see where you are. And especially if you're between 55 and 60 right now, it's not too late to really finish up some good, solid planning to really change your retirement outcome.
And that big number that I said there is what you need at retirement. So if you're still 10 years from retirement, you may need half that now to be on track, right? Or maybe even less, depending on risk tolerance and other factors. We really think it's going to be a great 10 years in the market. So there's no time like the present to get started here. It's really pretty amazing how the plan will come together in the last 10 years before retirement.
And some people estimate that they'll need probably half the amount of money in retirement that they did when they're working. That is a tremendous underestimate, because I think realistically most people need probably around 75, at least 80% of the money that they had working, and they're going to need that in retirement. So how do tools like annuities and pensions and Social Security fit into this picture?
Jeff, that's really insightful. I think people seem to think that when retirement comes, it's time to pull your horns in and not do anything and sit down on the couch and keel over, right?
Yeah.
I don't think that's true at all. Now, I will say this. The baby boomers are probably less that way than my folks, and especially my folks. Baby boomers, we want to have our cake, and I still want to eat it.
Yeah, sure.
We need 2 cakes, right? So
lots of whipped cream and topping on that too. Bring it on.
Exactly right. So that being said, I think that you're probably right. I think people in today's world really want to retire and not change their lifestyle. They're going to need just as much money in retirement as they needed before they retired. Now, could people live on less? Absolutely. They could. Do they want to? Absolutely not.
I think one important distinction to make here is you need, in my opinion, and Randy, you can feel free to say what you think about this, but generally speaking, and this is an overgeneralization, people do not fit into nice, neat little boxes this way, but on average, I would say you need 75-80% of your gross current income. Your take-home income will be roughly the same at that level, depending on how much money you make, depending on how hard you're funding your 401k, things like that. So I would say to make it, what we want to do is make it feel roughly like it does now from an income standpoint, but you will need a little less income to make it feel that way because you won't be funding your retirement plan, Social Security, tax, FICA, payroll, workers' comp, all that kind of stuff. So maybe shoot for 80% of your current gross income in retirement, and you'll probably be good enough to be about where you are now. Another way to look at it is look at your take-home check in, let's say, in monthly increments. So if you're twice a month, times 2, take your monthly current amount that you have take home and then add back in what you need for taxes and health insurance. And that's another way to arrive at the number that will likely make sense for you.
100% accurate, Jake.
Good advice. I think the single most important thing that someone can do to make sure that their money lasts as long as they do is to have a plan. It's that simple. Review it as often as you can. Adjust as life and markets change. Talking with Randy Jake Floyd Financial Group, running out of money? You do not want to do that in retirement. If you want to come up with a plan that will ensure or at least hedge the bet against running out of money, call us right now. Request your Floyd Financial Group retirement review. No cost, no obligation. 417-889-7233. We would love to help you. No cost, no obligation. Certainly no judgment. We'll meet you where you are. We're also online at FloydFinancialGroup.com. Randy and Jake, let's take a break. When we come back here on Show Me the Money, we're going to be talking about a new trend. It's called phased retirement. When our program continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready to climb a mountain of financial know-how? Good, because it's time for more Show Me the Money with your financial Sherpas, Randy and Jake Floyd.
Well, welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money, and in this segment, we're going to be talking about a new phrase called phased retirement.
And today we're talking about a growing trend, Randy, among retirees. As you said, it's called phased retirement. And instead of stopping work cold turkey, more people are choosing to transition gradually. So let's start with the basics. How exactly would you describe phased retirement for someone listening right now?
Yeah, so for a while there, I thought you were talking about Captain Kirk using his phaser.
Yeah, exactly. A lot of those things in Star Trek have come true.
It's true.
I know. Gene Roddenberry, he was way ahead of his time. But
yeah, he surely was.
Yeah,
ready to get beamed up and not have to fly anymore.
Oh, wouldn't that be the greatest thing? Beam me up, Scotty. Well,
that's right.
I don't think I want to be the test tube, guinea pig for that one.
Yeah,
we got his head, but we didn't get his arms or a hand or something like that.
That's not good.
Let's go back to the drawing board. Phased retirement, what is that? How would you describe it?
So basically, it's a gradual transition from full-time working to full retirement. Instead of just quitting all at once and going cold turkey. And I will tell you that as I talk to people, and I even have some people that have come to me at church and places where I have some other social engagement, and they said, I'm thinking about retirement, but I just don't know what I would do. Or the wife will go, please don't let him quit yet. I don't want him home under me all the time.
Right.
Or shortly after retirement, Randy, please call him to play golf.
Yeah, I think I would call it the workaholics retirement plan.
Yeah.
Because there's some people that, they put 80, 100 hours a week into their career, and to just stop that out of nowhere would totally upend their lives. And I think there's a lot of people that want to still be productive in retirement, and this can be a way to make it not seem like you're reversing course. So there's a lot of people that have trouble taking money out of their investments to live on, And this is a good middle ground for people that have that trouble to say, hey, I'm going to quit my main job, but I'm going to go work 15, 20 hours a week, at Bass Pro in the fishing place or whatever. It's not about the money, right? It's about occupying some of your time, all that time that you were giving to work, and kind of stepping down into retirement.
However, for some of the spouses at home, they're all too happy to see their checks keep coming in.
Oh, yeah, absolutely. I just bought a mattress a little while ago, and I was surprised you have a 120-night sleep trial. And I thought, well, if I don't like it, I can take it back. Sort of like that with retirement. I mean, if you phased in retirement, you get into retirement a little bit, you decide you don't like it, you can reverse course. But I think really just phasing in is the way to go about it. And I think about cruising down the freeway. Speed limit 70. I know, Randy, we know we can probably go 80 without a ticket, but we're not going to slam up the brakes and come to a screeching stop. We're probably going to slow down before we hit that accident. Same with retirement.
Yeah, so I think it's gaining a lot of traction, and there's a lot of people that say, well, these dadgum baby boomers, they need to go ahead and finish their retirement and get out of the workforce so I can have their job.
Well, yeah.
Be careful what you wish for.
Exactly right. Be careful what you wish for, because there's a lot of positions to be filled and that can be filled on a part-time basis. Myself, I've kind of taken that approach to what I have done here, and everybody pretty well knows that now. And honestly, I think that it's a good thing from two perspectives. I think, number one, it can help make the transition for the new employee taking the position to take a little pressure off them, while at the same time, for the person that's retiring, taking a little pressure off them as well. And I think it can be a win-win for everybody. One of the articles I was reading the other day was somebody said, well, I told my boss I was going to retire, and so he booted me out the door. There may be a few of those that will go that way, but generally speaking, I think that employers want a smooth transition when people are leaving. And we've had it set up where we've had people stop working and immediately get a contract to work for the employer as a contract employee, a 1099 employee, rather than a full employee, and actually make as much or more money, and it actually costs the employer slightly less.
Yeah, because they don't have to pay the benefits.
Right. So there's a lot of advantages to that, and it also helps people sometimes. I say, man, we're good with our retirement plan. It's great, but you know what? I'm going to work part-time here for a while and save a little bit more money, or I'm going to work part-time here for a while, and we're going to travel and do some things we want to do and buy a few things we want to buy before we go whole hog. And this is a way to help fund that.
From a financial perspective, what are the biggest advantages of phased retirement, do you think?
Well, again, just the extra money. And I think for some people, the idea that, hey, I still have value. Some people, their career is their total identity. And once they leave, there's a big hole there, and they need to figure out some social relationships and, playing pickleball, playing golf, riding mountain bikes, doing triathlons, swimming, or whatever it is they like to do. They need to figure some of that out. And also some other things that are kind of interesting is figuring out with your spouse kind of how retirement is going to feel and how does that work, because you've been spending 8 or 10 hours a day away from your spouse, and now all of a sudden you're right there, as some spouses would say.
Right. Don't you have something to do or someplace to go, Randy? Please ride your bike, go play golf, just do something.
Yeah.
Except being right next to me asking, what are we going to do next? Yeah. Has Lisa ever said that to you?
Honestly, I have probably, well, no, not probably. I have the most incredible wife on this planet.
I know.
And I know there's people on the radio that would say, no, mine is. And good for you if you think that, because that's the way it should be, right?
And that's probably why you're still married.
It is probably why I'm still married.
Right.
We're headed for, let's see, this year will be 43 in January for Lisa and I.
Congratulations.
Yeah, she's been a tough woman, I'll tell you.
Elizabeth and I were at 20 this year, so we're coming for you.
Congrats. Congrats, guys. When you first started out, here you were in what, cowboy boots and dirty shirt and everything, and she was bringing you home to mom and dad. And how did that go when she brought you home? And you're talking about, it's like you were working in an oil field or something like that. I forget what it was.
Yeah, well, her dad was either very insightful or very gracious.
I think it was
or
gracious.
maybe both.
Yeah.
Knowing my grandfather, I doubt it was gracious.
You don't think so, huh? And when you ask,
I love my grandfather, but
Yeah.
I don't know that that's how I would describe him.
and Randy, when you asked Lisa, what does your father do for a living? She said, well, he's in the pizza business. You thought he made pizzas at the local pizzeria.
Yeah, I could just see it, him throwing the dough up in the air, spinning and catching it on his fist.
Once again, knowing my grandfather, I can't see that actually.
No. Didn't he? I mean, it was some sort of managerial job within.
Yeah, he was the president of Pizza Hut at the time. He worked for PepsiCo, the corporation.
I'm not sure that he ever managed a store, though, did he?
No, he never did.
Because he was already higher up at McDonald's.
That's an interesting story. I love that story, though. Lisa bringing you home, and the biggest thing, you're thinking he makes pizzas as opposed to. But if you give a general answer, he's in the pizza business. I mean, what else can you expect? But it makes pizzas, probably. But from a financial perspective, the biggest advantage of a phased retirement, I think, is that it gives retirees a chance to test their budgets and to see how much income that they truly need. It also allows Social Security and retirement account withdrawals to be delayed, which can increase lifetime benefits. Plus, I think reducing work gradually, it can ease healthcare cost pressure. What would you say to someone who says, I'd like to phase in retirement, but I'm not 65 yet? The thing that's keeping me working is going to be healthcare. How often does that come up, Randy and Jake, and how do you address that problem?
Yeah, that comes up a lot. For most boomers that are getting ready to retire, that is one of the biggest things that holds them up, is waiting to get to Medicare age. And I got to tell you too, Jeff, yes, people have health conditions and they have reasons for wanting to get out before age 65. But I got to tell you, if you've taken good care of your health and if you've worked at it, I don't think 65 in many cases is too long. Again, people have different situations in life. I'm not saying you're wrong if you want to retire at 62 when you can and draw your Social Security, or even before. I'm not saying that at all. I don't want anybody to read that into this. But working to 65, I think it's okay. And I also think that we're going to live longer and longer, and we're seeing that. I remember when my grandma Maggard on my mom's side, I remember her being 66, and she could barely get around.
Well, yeah.
Lots of people were that way back when I was growing up. Today, not so much, especially if they've taken care of their health. I met some people here a couple of days ago that were in their mid-60s, and I'm getting a little past my mid-60s now.
You and me too.
I looked at these guys, and we were like a bunch of kids in the park. We were out there talking in the parking lot, and we're all talking about pickleball, riding bikes, and doing things that my grandparents would have never considered.
Right. We took a look at a picture of my grandfather, my brother and I, and he said, Grandpa was my age when that picture was taken. He looked like he had been, as you said, drugged through a knothole backwards, and he just did not look healthy at all. Now, I've conquered the retirement question by deciding that for me personally, retirement is just not something that I want to do. Is that okay if you decide, well, I just think that my purpose is going to be doing what I do because I like what I do. I love talking to you guys on the radio. I love helping people with their finances, and there's no heavy lifting, and it just seems like something that I can do, but I can fit in the things that I want to do. Is there any problem with continuing to work and never retiring, do you think?
No. Not at all. We should ask Warren Buffett that question.
Yeah.
Or we could have asked Charlie Munger before he died at 94.
Yeah, my sister was talking to me and she said, I find that most healthy men who are active and, are having a good life are still working. Do you find that to be the case?
They're either still working or they have a vocation or something that keeps them moving, going, cognitive, and it's something that takes a little bit of their own volition to do.
Right.
And that keeps you sharp, I think.
Right. I'm watching a YouTube channel, not really a channel, but someone who contributes to YouTube. And her father is 84, going to be 85 years of age. And he restores cars, and he is out there 10, 12 hours a day. He's taking these cars apart and he's putting them back together again. And he seems to be an extraordinarily just healthy guy. Big trailer, big farm, and he's putting the cars on, and they just took a cross-country trip with a car that he just built, and he's not done with that. He's come back, he's going on another one. So I think keeping active in retirement is probably going to go a long way towards you being happy and healthy in retirement. But again, if you don't retire and you continue to make money, I would imagine that that's a great way to not run out of money, is to continue to have an income.
If you enjoy it and you like it, that's what matters, right? If you like it, it's not work. So for me, when I get up in the morning at 4 a.m. and I go out and I hop on my bike and I turn on my headlight and put my blinking light on the back and turn my bike radar on so I don't get hit from behind, and I'm in the aero position on my time trial bike, I'm like, man, this is so good. And people go, have you lost your mind, Ricky?
Right. Well, you're an unusual person, but you've always gotten up at that hour of the morning. But when you were a kid, you weren't riding bikes. What did you do at 4, 5, and 6 o'clock in the morning?
Well, in the morning, my dad always got me up because he just thought that it was ridiculous that anybody would sleep past 6 o'clock. And he was raised on a farm by his dad. And like I said, they always had hired hands and a pretty good size group of people. I remember my grandma feeding us breakfast. We had this great big table. And as a kid, I'd go in there and there'd be, 25 biscuits and 4 pounds of bacon.
I know.
And all this sort of thing. So we were always up early. And my mom said, the Floyds always got up really early, 4 or 5 o'clock. Not at my house. My Maggards, she said, we got up like 7.
Which is still relatively early as far as I'm concerned. I don't know about that. But I don't knock off work at 5 o'clock. I take a break and have dinner, but a lot of times, for me personally, I like to do things on my computer, and they're often work-related. And I'll be doing things like that, some creative things, until 9, 10 o'clock at night, because there's not much on TV that I want to watch.
Right. Everybody's a little different, but again, we've just always been, I've been kind of plumbed to get up and do that. I'm one of those guys, though, that you get me to 5 o'clock, I'm just about done for the day because I'm going to be getting up at 4 tomorrow morning, so I'm going to be asleep by 8:30.
Well, I need my 12, 13 hours of sleep. I think there's probably something wrong with that, but I'm going to get that checked out. Phased retirement is a great idea for those people who want to retire, not sure that they want to do it cold turkey, but there is a good way to phase into retirement, and there's a bad way to do it. I think the first thing that we should invite people to do is to call us here at Floyd Financial Group, talk about a phased-in retirement. Let's go ahead and take a look at your finances and talk to you personally and see whether or not it's the right choice for you. Again, our phone number, 417-889-7233. If you want to talk about a phased retirement or anything else that relates to your retirement journey, we'd love to help you. No cost, no obligation, no judgment, 417-889-7233. Randy and Jake, I always enjoy our time on Saturday mornings. We always get off on a tangent like this, and I wish people could hear the conversations that we have before the show, because we talked about everything this morning. We talked about who had the best voice in terms of vocalists, and gosh, so many different things like that. We'll have to do that one of these days, but for right now, time has run out on us. So for Randy and Jake, I'm Jeff Shea. Thanks so much for making us part of your weekend. I invite you to join us again next week right here with another edition of Show Me the Money on 104.1 FM KSGF, where Springfield comes to talk.
The information provided in the preceding program is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning is offered through Floyd Financial Group, LLC, an SEC registered investment advisor.